The internet is on fire. BlackRock pulling $2 trillion out of America? Dollar collapse imminent. I spent 10 hours diving into SEC filings and Treasury mandates. What I found will surprise you.
This is a textbook case of financial misinformation. Let's expose what's really happening with the world's largest asset manager.
Number 1. The viral claim.
The claim spreading across social media, BlackRock is withdrawing $2 trillion from U.S. markets. Videos compare it to Spain's currency collapse, Britain losing reserve status. Fear is spreading fast.
Here's what actually happened. 3 separate financial events got merged into one sensational headline. Let's dissect each one.
Number 2. Custodian shuffle.
December 2021. BlackRock moved $2 trillion in ETF assets from State Street custody to multiple banks, including Citigroup.
This was risk management, not capital flight. Imagine keeping all your money in one bank versus spreading it across 3. Same concept. The assets never left U.S. soil.
This 3-year-old story resurfaced because someone connected dots that don't connect. The money just changed which American bank held it. That's it.
Classic financial recycling. Old news repackaged as breaking crisis.
Number 3. Portfolio positioning.
December 2nd, 2025, BlackRock releases their 2026 investment outlook. They're going tactically underweight on long-term U.S. Treasuries.
Stop right there. Underweight doesn't mean selling everything. It means holding 5 to 10% below benchmark allocation.
BlackRock manages $10 trillion globally. An underweight position might reduce long-term Treasury holdings by $50 to $100 billion, not $2 trillion. And critically, they remain overweight on U.S. stocks, especially AI and technology.
Why the shift? U.S. national debt exploded $2.3 trillion in 11 months, from $36.1 trillion in January 2025 to $38.4 trillion by December. That's faster than predicted.
When government debt hits 100% of GDP, bond investors demand higher yields. They want compensation for inflation risk and fiscal uncertainty. Long-term bonds with 20 to 30-year maturities could lose value if interest rates spike.
BlackRock is protecting clients from duration risk. This is professional portfolio management, not abandoning America.
Number 4. Regulatory change.
The SEC's 2026 Treasury clearing mandate. Starting December 31, 2026, most Treasury transactions must clear through central counterparties like the Fixed Income Clearinghouse.
Translation? Instead of 2 dealers trading directly, all Treasury trades now go through a central clearinghouse.
Why does this matter? Systemic risk reduction. If one major dealer fails during a trade, the clearinghouse absorbs the loss instead of triggering a market-wide panic.
Remember the 2008 financial crisis? Lehman Brothers collapsed and nearly took the entire system down because of interconnected bilateral trades. Central clearing prevents that domino effect.
This affects transaction mechanics, not investment decisions. BlackRock and every other institution must update their trading systems. No money is leaving the country.
Number 5. Hypothetical scenario.
Let's play this out. If BlackRock actually withdrew $2 trillion from U.S. markets, what would happen?
Immediate chaos. Treasury yields would spike 100 to 200 basis points overnight. That's $2 trillion in selling pressure flooding the bond market simultaneously.
Mortgage rates would jump 2 to 3% within days. Corporate borrowing costs would explode. Credit markets would freeze as banks panic.
You'd see it everywhere. Bloomberg terminals flashing red, CNBC breaking news, global central bank interventions.
And here's your proof this isn't happening. Treasury markets are stable. The 10-year yield is moving normally. Daily trading volume through FICC is $9 trillion with 0 disruptions. No crisis exists.
Number 6. The real picture.
So what is BlackRock actually doing?
Strategic rebalancing. They're reducing exposure to long-term government bonds because of elevated debt levels. They're increasing allocations to private credit, infrastructure financing for AI buildouts, and selective international diversification.
They're not alone. China reduced U.S. Treasury holdings from $1.3 trillion in 2013 to $760 million today. Japan cut $220 million since 2022. Saudi Arabia, Belgium, France all trimmed positions.
This has been happening gradually over a decade. It's not sudden panic. It's slow-motion portfolio optimization as the global economy evolves.
BlackRock remains bullish on American innovation. They're overweight U.S. equities, betting big on artificial intelligence, semiconductor manufacturing, and technology infrastructure.
Their message is clear. Be strategic in fixed income, but stay invested in American growth sectors.
Conclusion.
Bottom line, the $2 trillion withdrawal claim is fiction. It combines a 2021 custodian switch, standard portfolio advice for high debt environments, and regulatory infrastructure upgrades.
3 unrelated facts twisted into financial fear porn. The Treasury market processes trillions daily without issues. The dollar remains the world's reserve currency. BlackRock is optimizing portfolios, not abandoning America.
Real concern? U.S. debt at $38.4 trillion does constrain fiscal flexibility. Interest payments consume more of the federal budget each year. That's worth monitoring.
But monitoring doesn't mean panic. It means smart diversification, understanding duration risk, and not over-concentrating in any single asset class.
Financial literacy is your defense against clickbait. Always check SEC filings, company outlooks, and official sources before reacting to viral claims.
If this deep dive added value, subscribe for fact-based analysis on economy, technology, and financial markets. We cut through the noise and deliver insights that matter.
Hit subscribe for latest updates on USA market trends, regulatory changes, and economic data that impacts your financial decisions.
Thanks for watching, and we'll catch you in the next one.